Hello and welcome to the ETF show, taped right here at the New York Stock Exchange. I'm your host, Kristen Myers, ETF Editor-in-Chief at Asset TV. So we are just over a week away from the next Fed rate cut meeting, and markets right now are predicting with an 85% chance that the Fed is going to cut rates by 25 basis points. And bond ETFs have been performing well so far this year. So for more on the fixed income landscape, we're joined now by David Braun, Managing Director and Portfolio Manager at PIMCO. David, thanks so much for joining me today.
Thank you for having me, Kristen.
It's a very exciting time, I think, for us to talk,
is.
not just because of the holidays, but because of everything that we have going on in the fixed income landscape. So as I just mentioned, we're days away from what everyone is presuming to be a rate cut from the Fed. How is PIMCO really looking at the fixed income landscape right now?
Yeah, so first, holistically, we're very constructive and positive on core fixed income right now. And that's kind of, yes, we're a bond shop, but that's kind of a new story, right? Bonds have had a rough go at it recently. But if you look at the math, bond yields are pretty attractive right now. The Bloomberg US aggregate is yielding somewhere around 4.40, 4.5. That's very attractive on a historical basis. An active manager like PIMCO and funds we run in ETFs, BOND is our ticker for our active ETF trying to beat the ag. That's over 100 basis points higher yield. So you're looking at yields in the mid fives, maybe even pushing 6. And that's with the backdrop of slowing economic growth. That's at least our call for the next couple quarters. And we're in the middle, as you astutely point out, in the middle of a Fed cutting cycle that's likely to continue. That's usually a good backdrop for bonds, especially when you're starting with these yields. And if you further look at it, you could argue that stock valuations are pretty robust, right? Like how many new highs have we set this year on the S&P? And bonds, we believe, will provide a nice diversification from one's equity risk in their portfolio. Now, we also firmly believe in active management. And this has been a really target-rich environment for an active manager. We've had tremendous amounts of uncertainty in the outlook. Uncertainty breeds volatility. And then we've had dispersion across asset classes and global economies. Those three ingredients, uncertainty, dispersion, volatility, are kind of like an active manager's dream scenario, because you can make alpha when that's going on rather than when everything's calm and moving in tandem. So go ahead.
No, you just mentioned a couple of things. I definitely want to talk about yields, but I do want to ask you, you just mentioned the active suite. PIMCO has a pretty full active suite when it comes to fixed income. I mean, how is PIMCO positioning when we're looking at that active suite ahead of these rate cuts?
Yeah. So good question. So we believe we have a much stronger edge at kind of figuring out the long term, the multiple quarter or a year horizon rather than the next 30 days. And this is particularly difficult because think about what we just had. We had a government shutdown where government data wasn't being released. Right. Jerome Powell referred to, if you're driving in the fog, you slow down, right? And certainly they're slowing down. So think about it. We're now just getting some data that was supposed to be out a month ago, 2 months ago. So we still don't even have a full picture of what September, October look like, let alone November.
Right.
So, but our math is the private sector data is indicating that we are seeing stagnation in the job market, stagnation in the manufacturing sector, pretty decent retail spending by the consumer. We Americans are good at spending money, I guess. But that clouds the picture for the Fed. And, we had a high probability on a December cut, but we're shifting that probably equal parts to December and January, right? If they don't cut in December, it's not because the data is not weak like we think, at least that's our view. It's because they don't have the data.
Right.
And they'll kind of defer that as kind of like a safety, like just wait till next month. So our base case is a cut either next week or in January based on declining data.
So I have to ask, because you've already pulled out your crystal ball for me. So I'm curious to know, if we look at the rate cutting cycle in 2026, do you have a view on how many cuts we might expect?
Yeah, so look, a couple of things to think about. We're going to have a new Fed leadership, right? Like the headlines today where Trump's picked somebody. He hasn't told us who it is, but let's see who that is. So we have new leadership coming in. Our view is the Fed stays independent, and that independence is not at risk. But it's possible that the new Fed has a more dovish chairperson. We do believe they will remain data dependent. So you could very easily, if our base case scenario happens, which is a couple quarters of slowing growth, namely fourth quarter this year, first quarter of next year, steadily declining or stabilizing inflation, where once you net out the tariff impact, we're in that 2 point something that the Fed wanted to see. That could pave the way for 2 or 3 more cuts next year, getting you closer by the end of next year to that neutral point of 3% on Fed funds. Now, one of the flies in the ointment is, in addition to just what is the composition of the Fed, but also the stimulus from one big beautiful bill hits in tax day, April 15th of next year. A lot of people are going to get bigger tax refunds than they expected, right? If you earn tips or overtime, if you're eligible for the $40,000 SALT deduction instead of $10,000, that's a big stimulus package. So that might cause an impulse in growth, an impulse in inflation that might kind of cause the Fed to have to pump the brakes a little bit on the cutting cycle.
So then I have to ask, because I want to talk about duration, right? You were talking about yields a second ago. We're going to get back to that. So a lot of people have been talking about duration again. So how are you thinking about duration exposure right now? Is it time to move away from the front end, move towards the back end?
Yeah, we do. We believe that, right? So a lot of advisors did a heck of a job moving their clients into cash, right? Sidestep the carnage of 2022. But that trade in our minds getting a little long in the tooth, right? The Fed's already cut from a high of 550. Good chance we are in the lower threes in the next 12 months. So your cash yields and anything floating rate tied to floating rate instruments is going to be coming down in lockstep with that Fed funds cut. So, and it's funny because I think people got comfortable that cash was king,
right,
because we went through the longest period of an inverted U.S. yield curve. Like, look, when that U.S. yield curve was inverted, it was the longest we stayed there. So cash was steadily yielding more than an ag-based fund. That's gone. Ag-based funds are yielding more than cash, much more, and you've got the downside protection that an ag-based fund will rally if the stock market gets in trouble, like we saw earlier in the year when the stock market was down. So therefore, we believe advisors who are still sitting on the cash, and by the way, what is there, like 7.6 trillion still in money markets? We do believe people should start thinking about pushing that out, locking in these yields, and getting that diversification benefit from their equity portfolios.
So then let's talk about the yield risk, right? And duration. How are you thinking about that?
Yeah, so we as humans and investors especially, we run from the last fight we lost, and oh boy, did we lose a fight in the bond world in 2022, right?
Yeah.
So I think everybody knows now that 2022 was the worst year for the ag. It's been well written about, but 2020 through 2023 was also the worst 3-year, and 2020 through 2025 was the worst 5-year. So, you weren't having me on the show 3 years ago because bonds were kind of a 4-letter word, but that's the past. And the recipe that led to those poor years, it's really hard to see it being repeated. Like, let's just start what happened in 2022. We entered that year with the ag yielding somewhere around 1.5, 1.75, somewhere in that range. That's not much forward momentum. Then you all of a sudden get the first inflation fight in the United States in 40 years, and Jerome Powell has to hike all the way up to 550. That is a recipe for a horrible year, and that's why the ag was down 13%. Now we're starting the period with the ag yielding, close to 4.5, an active manager yielding at least 100 basis points more than that. That's tremendous forward momentum to defray any pain if rates back up. It's almost like you got the first 100 basis points of rate rise on the 10-year covered by your starting yield. So I think a lot of investors are like, well, I got run over by a car on bonds in 2022. I'm afraid of it now. But this is why math nerds like me gravitate towards bonds and not stocks. The math has to hold together. If I'm starting with a 550 yield and I've got a duration of 6, it takes a lot of rate rise to cause my 550 yield to be tidal waved by that rate move.
So this is actually why I think we see so many investors, so many advisors actually really like active for the fixed income space. It's just more nuanced and they can really generate more alpha by staying active here. So then how are you guys balancing some of that credit risk inside of the ETF line?
Yeah, that's perfect, right? So if you're passive, you just take what's in the index, right? Someone came up with an algorithm that says these bonds are index eligible and you just buy. It's paid by numbers. We think that's a horrible strategy in general, especially in this environment. Remember what I said, uncertainty, volatility, dispersion. Let's just talk about a couple things. We can move our duration around. Just think about the past year. We went all the way up to 480 when it was like peak Trump bump in late January, early February. We went down to 4%. We're at 4% again. An active manager can kind of lean against that if you have a view on where rates are going to be. And we've been talking about the 10-year being in a 375 to 475 range. So we can lean against that and trade when the market overreacts one way or the other. Also, the shape of the curve. Everyone's like, oh, duration management, you just want to be long or short. No, different parts of the yield curve move with different velocity. So we could pick which points of the curve we want to be overweight, which points we want to be underweight, and make alpha that way. But furthermore, the genesis to your question hit credit, and I'd be remiss if I didn't deep dive into that. If you look at public investment grade corporate spreads right now, and public high yield corporate spreads, they're essentially the richest, 5th percentile for the last 20 years, meaning only 5% of the time were spreads tighter than they are now or lower than they are now.
Right.
That's not a good scenario.
Right.
And they're kind of taking their cues from the complacent stock market with all-time highs. That does not sound attractive to us when we have slowing growth, this kind of window of weakness in the economy. Why are we accepting spreads that are lowest in 20 years? So what we're doing in active management is kind of really de-emphasizing corporate credit, almost a de minimis amount of high yield credit in our ag-based fund, in our multi-sector credit funds, like a P yield in the ETF space, PYLD, and getting our exposure through securitized product. Things as simple as Fannie, Freddie, Ginnie government guaranteed mortgages look incredibly attractive, not just versus treasuries, but versus investment grade corporates. And then going into the top tranches of other AAA securitized that doesn't have a government guarantee, like CMBS, consumer cards and autos, non-agency loans, things like that.
So where are you seeing the most inflows into the active, fixed income strategy?
Yeah.
So you have a bunch.
You probably know the data better than me, but this was a gangbuster year for active fixed income in the ETF space. Yeah. Now, the stock of ETFs and fixed income is still dominated by the passive, but the rate of change is really favoring active. And we've been waiting for this at PIMCO, right? We launched Bond in 2012, and I think Mint in 2009, and it was largely a passive-dominated space, and now active is taking off.
Is there a section inside of active that is more attractive to investors than others?
So where we, again, you have good data too, but we see about 70% of the flow coming from two main sectors. One is the ultra short, like a lot of the floating rate products that were launched, like floating rate CLOs. They did a good job again sidestepping that. Again, our concern with the ultra short is as Fed normalizes rates, we know they want to get to 3%, and some of the doves that may be on the FOMC in 6 months probably want to get lower than that. So you've got a risk that your cash and floating rate ultra short yields come down really fast. And again, they also don't rally if the stock market gets in trouble. And so out of the 70% flows, we're seeing about 30% going to that. And then the other 40% is going into kind of ag-based or multi-sector like bond and P yield. And we think that makes sense. Like they have durations anywhere from 4 to 6. And that's a stark sign that investors are appreciating the value of kind of pushing out the curve, locking in some of these yields, getting some diversification from their cash and their equity positions.
Do you still see a role for ultra short duration inside of portfolios in 2026, considering what you just said about this rate cutting cycle that we're looking at?
Yeah, of course. I mean, 7.6 trillion in money market, that's not going to zero. People need cash for things. They also like cash for the safety of it. And it's, up to each person. And it's also like, if you got an ag-based fund that's a duration 6, you may not be comfortable getting out of something with duration 0 going into 6. So why not like barbell it? Why not have some cash for your liquidity? And if rates do rise, you're insulated. And then some duration bearing instruments like a bond or a P yield to kind of term out and lock in those rates a little longer. So you don't have to do it all in one ticket, right? You can have multiple tickets staggered across the yield curve, if you will.
Right. So where do you think that the market really is underestimating risk right now?
Yeah, so given what I said about credit, again, investment grade credit being priced at pretty much richest levels in 20 years, high yield, pretty much the same thing, richest levels in 20 years. And those two things are highly correlated with equity risk, right? Like if you put a bunch of investment grade corporates and high yield corporates in an ag-based fund and the stock market gets in trouble, I'm pretty sure your bond fund's going to do poorly versus someone who doesn't have that much credit. So we would argue people are underestimating the richness of credit, the richness of equities perhaps, and the high correlation between a credit-based bond fund and the stock market, right? So people are like, well, why would I buy an ag fund? I can go into a corporate fund or high yield fund and get 100 basis points more in yield. Yeah, but that thing has a high beta or correlation to the stock market, the very thing you're trying to hedge. So we don't think this is a market where you need to be greedy and add a bunch of corporate risk, go down in quality. High quality bonds, I already mentioned, can get you 5.5% yield, and bond P yield's probably 100 basis points higher than that. What's wrong with that? Why do we have to get greedy and go chase 50 higher than that and add a bunch of credit in there?
Honestly, I think we could probably talk about this for another 2 hours, honestly. But David Braun, Managing Director and Portfolio Manager at PIMCO, thank you so much for joining us. And thank you so much for tuning in to the ETF show at Asset TV.